Hello, everybody. Thank you very much for joining us today. My name is Justin Ivey. I'm a financial advisor with Egan, Berger Weiner, and it's my pleasure today to introduce Chris Hennessey, and we will be examining the Tax Cuts and Jobs Act in our webinar today. Mr. Hennessey is a member of Putnam's Business Advisory Group since joining the firm in 2008. He also serves as Professor Emeritus of Law at Babson College and a faculty director of Babson Global. He has extensive consulting experience on all wealth management topics relevant to financial advisors and to their clients, such as retirement planning, college savings, IRA distributions, advanced estate planning, charitable remainder trust, and asset protection strategies to safeguard wealth. Mr. Hennessey is a member of the American Bar Association, the Massachusetts Bar Association, the American Institute of Certified Public Accountants, and the Massachusetts Society of Certified Public Accountants as well. So, any further ado, let me pass this over to Chris, and we'll get started.
All right, thanks very much. And we can go to the next slide. All right, so there's a way to ask questions. And if we can just start out on, I guess, the following slide. Okay, great. So let me, if we can just go to the agenda slide, next slide in, I think. Great. So let me give you a little bit of background, folks, on, and thanks for joining the WebEx today, on where we're at with the Tax Act. And I'm going to go about 30, 35 minutes. You just saw a slide on the way to ask questions via email, and I'm certainly going to address questions as we go through. So this Tax Act came into effect back in the end of 2017, and the first full calendar year that it was in effect was 2018. Now, some of you may remember, we're going to talk about tax rates and tax brackets in a couple of minutes. You may remember that the media was reporting back in March or so that refunds were down. In other words, less people were getting a refund calendar year 2018 filing than had been the case in 2017. And myself, as a tax lawyer and C.P.A., kind of laughed at that and said, how stupid and irrelevant is that? A refund is based on how much money you pay into the system during the year, either through withholding or estimated tax payments. The real key thing to look at is what is your effective tax rate. So now that this has been in effect in a year, it turns out that just as many people got refunds in 2018 as had been the case in 2017. So we're going to look at some of the key parts of this tax law, what the marginal rates look like now, and what the deductions look like. We'll take a quick look at the small business deduction of 20% for flow-through entities. And more importantly, as I set this up for you, this in essence is a planning window of the next 6 years. Most of this Tax Act, we can segue to the next slide now, most of this Tax Act will expire at the end of 2025. And when we go into 2026, and you can see this down at the bottom of this slide that we're on, we revert back to where we were in 2017, which means there'll be a tax increase in calendar year 2026. Now, obviously, politically, got a lot of things going on down there in Washington, D.C., but politically, this could all change much faster if a Democratic president is elected. The Democrats could start to undo any of this tax law that they wanted to within reason in a very short period of time. So lower rates, as you can see, a lot of changes to deductions, no real changes to retirement education. You don't have to buy healthcare insurance anymore. And a lower corporate tax rate is permanent law, but everything else is really going to run out at the end of 2025. Okay, let's segue to the next slide. And there you go. That's a way to look at, and I'll explain this a little bit, to look at the Tax Act on the left and the previous on the right. The big change on this slide is the 37% under the current law top tax rate versus 39.6% on the other. Let's go a couple more slides, at least one more slide. Just forward a slide here. That's individuals. Yeah, so let's stay on that slide. So this is for couples. So the first thing I always point out is under previous law, the top marginal rate was 39.6%. But to get there, you had to be over $480,000 of income. Now, look on the left side of this slide. the top marginal rate is 37%, but to get there, you have to be over $600,000 of taxable income. So the good news is the marginal rates went down and the threshold dollar amounts actually went up. Now, because deductions changed in the sense that some deductions were eliminated, like you don't get a $4,050 exemption for you, yourself, and your children, it's hard to really compare this thing on the basis of just brackets. So one of the things I do two things. One, I've got a piece of paper in front of me that has marginal tax rates all the way back to calendar year 1913, which is when the income tax in the United States started. And if you look in 1944, 1945, the top marginal rate was 94%. If you actually look again in the 70s, like actually 1971 through 1980, the top marginal rate was 70%. And back in 52, 51, 53, 1953 was 92, 91%. Why? Because we had to pay for the war. Washington Post had an article that if you look at tax rates in the 1970s and 80s versus today, tax rates today are lower than they are in the 70s and 80s. We have never seen such a period of time of lower tax rates in general. And one thing you might want to do, I did this for myself just as individuals, take as the numerator of an equation, take as the numerator your total tax liability. Not what you got as a refund or what you owed, what's your liability? The denominator is your total income. That'll give you an effective tax rate. That's the only way you can compare this year to a previous year. And I did that for myself in 2018 versus 2017. I was exactly the same. So nationwide, about 80% of all people got a tax cut, albeit the average tax cut was about, maybe $1,600, $1,700. 5% saw an increase, mostly in so-called blue states. We're going to talk about why in a few minutes. The rest stayed the same. I basically stayed the same. All right, so we can go to another slide. Let's just go one more slide. Okay, now, this is important because, as you know, as shareholders, investors, there is a separate rate for capital gains and dividends if they're so-called qualified dividends. And this slide is saying, okay, if I'm a single individual versus married, in my income, let's just take married. My income's up to $77,200. My effective tax rate on capital gains and dividends is 0. The highest it's going to be is 20%. Now, there is a Medicare surtax that may kick in if your income married is over $250,000. That'll add another 3.8 to the 20. But this is a pretty low capital gains rate. And one planning tip in a family unit that you can use this slide or these rates. Let's say I have a daughter that's in law school and she's out in California. She's 26 years old, and I'm paying the tuition, and she has no other income. Well, I got some securities that I own, mutual funds, whatever. And if I sell those securities and mutual funds, I'm going to have a capital gains rate of 20%. But if I gift those securities or mutual funds to her and let her sell them, her tax rate's 0. So as a family unit, we're going to save money. So that's one of the ways you can use this particular slide. Okay, let's go to the next slide. Now, I'm not going to go through all the changes. I want to comment on a few things here. Notice the standard deduction. It's actually technically in this year, 24,400. So it's being indexed for inflation. I haven't seen the numbers for 2020 yet. But those numbers have doubled. That 12,000 and that 24 is double over what it used to be. So under today's tax structure, about 85% of all Americans are going to get the standard amount. That number used to be about 70%. In other words, they're not going to have to worry about itemized deductions at all. And the itemized deductions are the mortgage interest. I'm not going to go through that specifically. They decrease the debt limit a little bit, but most people are still able to fully deduct their mortgage interest and their home equity line interest. Now, the big one is the middle of the slide, that state and local tax thing, capped at 10,000 in total. So let me take you through that a little bit. If you live in a high income tax state and you add up your state income taxes, and some people actually have a city tax, like New York has a city tax. You add that up and you add your real estate taxes up. And maybe in calendar year 2017, those three numbers added up to 50,000. You were able to deduct 50,000. But in 2018, you're able to deduct in the aggregate 10,000. So this is a big, big change. When you think about states like New Jersey, New York, California, and then some other states, but those are probably the biggies. Where I am is not too bad. It's 5.5%. And then, of course, tax-free states. But those blue states really get creamed, and a lot of people are complaining about that cap. Now, I'm going to explain in a couple minutes why their complaints may be a little misdirected. Let's just take a quick look at medical. Medical, the threshold went up to 10%. It used to be 7.5%. No real change to charities, except the amount you can give to a charity has now gone up to 60% of AGI. AGI, folks, means adjusted gross income. That's all that means. All right, so let's go to the next slide. And this is interesting. Now, I'm just going to show you an example, but we'll stay with this slide in a minute. One of the things that's very fascinating is middle-class America that has children, there's a tax credit available, and it's actually doubled. It's now $2,000. It was $1,000 before. Most people never got the credit because the point on the bottom part of the slide is they got phased out. In other words, their income was too high. I mean, if you're over $110,000 on a married return, you lost the credit. Now that phase out has gone up tremendously. It's $200,000 if you're single, and $400,000 if you're married. Now let's just go one more slide. And okay, let's skip that one. We're going to come back to that. Let's go one more. Now this is a little case example. So this is a family of 4. And they got kids under the age of 17, so they're going to get the child credit. Look at the example. The income's the same between the previous system, in other words, calendar year 2017, and today. Standard deduction is $24,000 today, so it just in effect doubled, almost doubled. No personal exemptions. They're gone today. They're gone. They were $16,600 before. So taxable income is actually higher under the Tax Cuts and Jobs Act than it was before. But look at the taxes owed, $30,819. They're lower. Why? Because the rates are lower. Now, look at the child tax credit. They didn't get the credit before because their income was too high. Now they get the credit, and bingo, they owe $9,000, or practically speaking, almost 9, I'm rounding up, less in taxes than they did before. This is pretty dramatic, and this is an example of where if the Democrats get power and they begin to fool around with this tax act, they can't eliminate something like this because this impacts too many voters that's favorable. Now let's go back one slide to alternative minimum tax. So while this is a complicated area to understand, it's sort of interesting. This is a tax that's been in effect since 1970. And the background quickly is back then there were roughly, 150 Americans that were paying 0 taxes. So Congress said that's unfair. We got to have a minimum amount to pay. Now today, that tax has grown, and what basically happens is you compute your tax the regular way, you compute it the alternative way, and you pay the higher of the two, not the lower of the two, the higher of the two. Unfortunately, when you compute it the alternative way, you don't get the same deductions you get the regular way. So under the alternative way, you are not able to deduct state and local taxes anyway. So all those people in California that are saying, oh, I got a $10,000 limitation on state and local taxes, guess what? You probably won't never deduct them anyway because you're always in the alternative minimum tax. But what's dramatic is that it used to be 5 million Americans were paying AMT. Now the number's 200,000. And look at the breakdowns in income. The sweet spot was 500,000 or a million of income. 62% were paying AMT in that sweet spot. Today, it's 2%. So for all intents and purposes, if you were paying AMT, you're either paying much less AMT or you're down to 0. Again, I'm a classic example of that. My real estate taxes are high. My state income tax isn't super high, but it's high. I always paid, $8,000, $9,000 in AMT. Today, I'm paying 0. So I'm ahead 8,000 or 9,000 from that viewpoint. All right, let's go back to 2 slides forward. So one more forward. Okay. There's one comment on this slide that I want to spend a little bit of time on. It's the second one about the Roth IRA, because I'm going to add something to this. Roth IRA is a tax-free IRA account. You can create one and contribute to it, or you can take an existing account, like an existing IRA account or an existing 401k plan account, and convert it to a Roth. It's called a Roth conversion. Now, when you do the Roth conversion, you pick up income. So if I got $200,000 in an IRA account and I say, okay, I want to make that a Roth, I'm going to pick up $200,000 of income, pay the tax on the 200, but now I get my Roth IRA. Why would anyone ever do that? Because if I think tax rates 5, 6, 7 years down the road are going to be higher, why wouldn't I pay the tax today on the IRA account instead of paying it down the road at a higher marginal rate? That's the reason people would do this. And I do believe, folks, with a $984 billion deficit, and the deficit this current year we're in will be $1 trillion or more, we will be paying higher taxes in the future. So that's the reason. Now, all the point the slide is making is, hey, if you do the conversion, you can't change your mind. You can't cancel it. You used to be able to cancel it. You can't do that anymore. I'm going to slide one thing in here that's sort of new. When we put this deck together, it didn't really exist. That's a piece of pending legislation called the Secure Act. And the Secure Act has passed the House by a vote of 417 to 3. It is sitting in the U.S. Senate and eventually be called for a vote and will pass. It's going to do a lot of things, but one significant thing it will do is when you leave an IRA account to your children, a Roth IRA account to your children, or a 401k plan to your children, under today's law, they can stretch it out. In other words, they have to pull money out of it, but they can do it over life expectancy. A 23-year-old has a 60-year life expectancy. So they can stretch out distributions over 60 years. And that thing will continue to compound because of the stretch. However, under the Secure Act, the payout will be 10 years. You're going to have to take all the money out at the end of 10 years. The Senate version has a 5-year payout. So one thing to begin to think about, you can't answer it yet, but just begin to think about it, is, man, if that happens, I want to leave my kids a tax-free Roth, not a taxable IRA. Okay, so let's talk a little bit about estate gift taxes. And the big change, of course, is the $11.4 million amount. Most people are going to be well under that. That means a married couple can shelter $22.8 million. And you can still always give away $15,000 a year to anyone you want. And by the way, the previous slide had 5 to 9 plans on there. You can also give away 15,000 times the next 5 years into a 5 to 9 plan. So in effect, you've used up your 15 for 5 years. Now, first point I'm going to make is do not count on the 11.4. That number will come down to probably $6 million in calendar year 2026. So if you're married and you're under 12 million, you're not going to have to worry about, and you're never going to be over 12 federal estate taxes. But if you're over 12, this is the number down the road in time, you will have to do some planning, some advanced estate planning. So let's go one more slide because I think it covers the basics on estate planning. There we go. All right, so these are all the basics you need. You obviously need a will. Sonny Bono died without a will. Prince died without a will. You need a revocable living trust to avoid probate. Elvis Presley, 12 years of probate, 73% delays of his estate. You need a healthcare proxy, power of attorney guidance. One quick point in healthcare proxy. If you have children in college and they're away, so you got a kid from California that's going to school in Massachusetts, make sure that child, that son or daughter, signs a healthcare proxy under Massachusetts law, naming the parents as agents. Because what's going to happen, they come out here, they go to school out here, they get sick in Boston. Mom calls up the doctor, and the doctor says, I can't talk to you about your son or daughter because of HIPAA, unless your son or daughter has signed a healthcare proxy. But this slide is illustrating the basic package of documents that all of you should have. All right, let's go to the next slide. And there we go. Now, this is an interesting area. I'm not going to go through all of these points, but maybe there's 2 points that are important on this slide. One, the corporate tax rate for so-called C Corps was the highest in the developed world at 35%. There's now a flat 21%. That 21% will not expire at the end of 2025. However, the Democrats, of course, could raise that rate. And that is one of the reasons why earnings were pretty good in 2018 for companies that were saving money on federal corporate taxes. The other point I think is interesting on this slide, we're going to look at it in more detail in a couple of minutes, is this new 20% deduction. All right, let's segue to the next slide. Good. All right, great. So this isn't going to apply to maybe a lot of people on the WebEx. I'm not really sure, but I'll just take you through it so you get the basics of it. When you have a business, you can have a sole proprietorship, you might have a limited liability company, a partnership, or a so-called S Corp. Those are all pass-through entities, meaning that as a pass-through entity, The profits from those businesses are picked up on your own individual tax return. They're not picked up on the business tax return. So under the change in the law, because of this tax act, there's a new 20% deduction. QBI is nothing more than the profit you pick up on your own return. So if myself and Sally have a pass-through entity, we have an S corp, the profits are 200,000, 100 to her and 100 to me, I'm going to get a new deduction, 20% times 100 on my own individual return. That's a $20,000 deduction. Now, you do have some restrictions, more severe restrictions, bottom point in the slide. If you're a specified service business, and generally that's going to be the area of health, doctors and so forth, lawyers, accountants, actuarial science, brokerage firms, and professional athletes, actors, actresses, consultants. So let's go to the next slide. We can kind of, there we go. We'll kind of go through this a little bit. This is a complicated slide to understand, but the starting point would be non-specified service businesses. And the income numbers you see in red on the right side of the slide are married return. Actually, they're a little higher today, but we'll use the numbers that are on the slide. So if my income is 0 to 315, I'm going to get the 20% deduction. If you go back to the previous example, we've got this manufacturing business with Sally. Now, if I'm between 315 and 415 or above 415, I have a wage test. I'm not going to go through that, but basically what that means is the deduction is the lesser of 20% or 50% of W-2 wages. If I have no W-2 employees, my deduction is 0. So you got to have employees, or you yourself and your business partner or partners have to draw salary up. Now, the right side would be I'm a service business. I'm a law firm. I'm a lawyer. I'm an accountant. Now, there's no wage test, but once my income's above 415,000, my deduction is 0. And between 315 and 415, the deduction begins to phase out. So any of you as business owners, if you're a specified service business, you got to watch your income. And if you do not have a retirement plan, I would suggest you look at that, because that's a way to put money away for yourself on a tax deductible basis and bring your income down and possibly get that 20% deduction. Also be careful of taking gains and doing Roth conversion, as that would push your income up. You got to work with your advisor and your accountant to make sure that all that's going to make sense, particularly towards the end of the year when we think about things like Roth conversion and capital gains. All right, so let's keep pushing forward. Go another slide here. And let's keep going. One more. So first planning strategy is kind of interesting. Again, this is a complicated slide, but I'll step you through it. One of the issues that's come up with doubling the standard deduction is, all right, this individual here, husband and wife, they're 65. They're giving away $10,000 to a charity, maybe religious organization. They have the $10,000 SALT limitation, state and local tax deduction, and $5,000 of mortgage interest. So if I add those three numbers up, that adds up to $25,000, 10, 10, and 5. But as a married couple, 65 or older, their standard amount's $27,000. So in effect, they're getting no benefit for the 10 grand to charity. Here's a better planning strategy. Lump the gifts. So let's take the 10 to charity and let's push $30,000 as a lump sum gift to charities into calendar year 2019. And then what we'll do in 2020, 2021, charity doesn't get anything. And thus, as you can see at the very bottom of the slide, we're going to get ourselves over the standard amount, and it gives you the math there, because we're going to give 30 to charity. We still have our 10 SALT. We still have our 5 mortgage. We're going to get ourselves over that standard amount in calendar year 2019. Very good planning. I mean, these are bigger numbers, but it's very good planning. And another way you can do this in working with your financial advisor is the use of a donor advisor fund. So the charity may have expectations. Oh, you just increased your contribution to us from 10 to 30. Well, you could give 30 away in 2019 to the donor advisor fund. The charity doesn't even know that. And the donor advisor fund could then dole out $10,000 to the charity this year, next year, and the following year. So this is a good planning strategy. All right, we'll go to the next planning strategy. Next slide. Now, this is something that is only available, this IRA donation to charities, if you're 70 and a half or older, and in that age category, you must pull money out of your IRA account. It's called the required minimum distribution. In fact, this is the time of year, towards the end of the year, you want to make sure you get this done, because if you don't do it, there's a 50% penalty in the amount you should have taken out. Well, here's a better way to do it. If you're giving to charity anyway, let's assume you have a required minimum distribution of $10,000, but you always give away $10,000 anyway to charities. Say to your advisor, I want the $10,000 required minimum amount to go to the following charities. So the money comes right out of your IRA account, goes to the charities, but you do not pick up that $10,000 as income on your tax return. Otherwise, what are you going to have to do? You're going to have to pick it up as income and then write checks out to the charity. But the example we just went through, if you're subject to the standard amount, it's not going to help you at all. Much better way to do it. And you can actually do this up to $100,000, as you can see. You can also do this out of inherited IRA accounts if you're 70 and a half or older, because you have to take money out of those accounts too. And down at the bottom of the slide, it gives you all the benefits. It's going to lower your taxation of Social Security. It's going to lower your Medicare premiums. And there are a lot of states where this will actually lower your income from a state income tax viewpoint. So this donation of IRA assets to charity, a lot of people are now doing this. Generally should be done. All right, so let's go to the next one. Next slide. And this, I talked earlier about the Roth conversion. Let me explain the slide in a different way. When you look at tax rate brackets, there's an interesting bracket. In that bracket, if I looked at a 2019 rate chart, I'm just going to give you the married numbers. If you're between 168,400 and 321,450 of taxable income, you're at a 24% marginal rate. You can see that in the slide. The number's a little different because this slide's a little dated now. Once you go above in 2019, above 321,415, your marginal rate jumps to 32%. So one of the things you ought to explore with your accountant and your advisor is, okay, let's figure out where I am for 2019. Let's run the numbers. I don't know, maybe through November, or at least through October. You can do that now. And November's halfway gone. And I'm at 280,000 in tax one income. I'm in the 24% marginal rate, but I could go another 40 grand of income and still be in that marginal rate, 24%. Maybe I should do a $40,000 Roth conversion. Maybe I should take another $40,000 of gains for some reason. So I call it filling up the brackets. And generally speaking, 24% or less is a pretty good bracket to be in. All right, so we'll go to the next slide. And we got a few minutes left here. Okay, so back to planning. I think because of the $8.4 million, it's a good time to review existing documents. So really do not need trust day for estate planning. Yeah, they need trust to probate, but they don't need a trust otherwise. Be careful of state death tax in Massachusetts. And although the federal exemption amount is 11.4 million, my exemption up here in Massachusetts is only 1 million. And one of the things about cost basis is when you die, any assets in your estate that you own yourself, the value of those assets from an income tax viewpoint gets stepped up to fair market value at death. So you want to think about that and take advantage of that in planning. And maybe you want to make, if you've got a lot of wealth, maybe you want to make additional gifts, because maybe you've given away 4 or 5 million, but now you can give away 11.4 million. So you want to give away another 5 or 6 million. So let's go to the next slide. Those are some advanced estate planning thoughts. And this is the closing slide. And then I think we're going to open it up for any questions you have. So here's my thinking on all of this. This tax act is the most significant piece of tax legislation since Ronald Reagan's 1986 Tax Act. Now, it's interesting to note in the last, 4 or 5 days in the news, Trump is pushing, Kudlow is talking about this, Larry Kudlow, another tax cut for the middle class, bring the rates down more. Frankly, folks, he can't do that now. He doesn't have enough, he doesn't control the House of Representatives, the Democrats do. But the Tax Act has gotten a lot of attention because it is a sweeping change, and it does mean you have to think about planning. It does mean that you should be working with professionals like your advisor to assess the impact this has on you as an individual, and make sure you're not missing deductions. Make sure from a planning viewpoint you're doing things like lumping charity, like if you have a business, you're taking advantage of that 20% deduction. You're thinking about the tax brackets. You're thinking about the Roth conversion because you think tax rates will be higher down the road in time. And I think you just got to pay attention to how this is going to impact your overall planning situation. Final comment I guess I'll make is my belief is we're in this window now, which presumably will be through 2025, where the rates are lower than they've ever been, or been some period of time anyway. Take advantage of that. And don't forget, if the political situation changes, you might only have a planning window through calendar year 2020, because in 2021, we could see a tax increase. If the Democrats get into power, they might begin to raise taxes. And you may have lost some opportunity if you don't do the planning now. So with that, I'm going to turn it back to the hosts for any questions. You do have a way, I think, to email questions in, but I'll end my thoughts there. Thank you.
Thank you very much, Chris. Yes, we do have a few questions here. So our first question is, so Chris, you said 150 people in 1970 paid no taxes, which is why AMT was started.
Right.
How many people today pay no taxes? I heard the number was dramatically more. And if yes, why is this happening?
Yeah, so I couldn't tell you offhand. It's broken down into percentages usually, but there is a fair percentage of the population that pays no taxes at all for a number of different reasons. And there's a lot of stuff being written. And actually, it's now going to come up in the political scene too about the inequality in wealth distribution and wealth spreads. In fact, Jamie Dimon talked about that, I believe, on 60 Minutes the other night a little bit. So there's just politically question marks about, do we have the right system? Now, interestingly, there's two things then that come up from there. One is what Elizabeth Warren is proposing if she became president, which would, one of the things she's proposing is Medicare for all, but the other thing she's proposing is a new tax, in effect, a wealth tax on the wealthy. In the Wall Street Journal, if you look at the Wall Street Journal, Tuesday, November 12th, read the article by Andy Puzder in the editorial section. I won't say any more. The other question I get a lot is, what about a value-added tax like they have in Europe and Canada? It could happen, but it doesn't raise enough revenue to replace the federal income tax. So let's go to the next question.
Okay. So the next one is concerning donating from an inherited IRA to a charity.
Yep.
So can you do this if you are younger than 70 and a half and need to take an R&D because the person you inherited it from was over 70 and a half?
Yes, the answer is no. I'm a great example of that. So I'm slightly under 70 and a half. I have an IRA from my mom when she died, an IRA from my dad when he died. And I got to take a required amount out of that. In fact, I'm just about to do it for this year. I cannot use the charity provision because I'm not yet over 70 and a half. Now, quick comment. I mentioned the Secure Act. Under the Secure Act, that age 70 and a half goes to age 72. So presumably, if this passes Congress and you reach the age of 70 and a half in calendar year 2020, you go all the way out to 72. I should have also said that if the Secure Act does become law and you have an existing IRA you inherited, your grandfather. This is only going to apply to IRA accounts, deaths on or after 2020. Okay, another question.
Okay, we don't have any more questions right now.
All right, that's great. Thank you.
Sure. Thank you very much, Chris. I appreciate that. That was very informative.
Thanks a lot.
Thank you. Okay, I'd like to let everybody know that this will be our last webinar for the year of 2019. The replay will be available on our website in the very near future. And I would like to thank everybody for attending today as well, too. And I wish you a wonderful Thanksgiving and happy holidays as well. Thank you very much.